Welcome to Retirement Straight Talk with Paul and William, featuring award-winning financial advisor and former host of the Sunday Money Show, News Talk 1010, Paul Baraka, and his associate advisor, William Baraka. Creating and keeping wealth does not need to be complicated. Paul and William will cut through confusing and contradictory financial advice to give you the real facts to help you invest better and enjoy a worry-free retirement. The views and opinions expressed in this video may not necessarily reflect those of IPC Securities Corporation. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.
Good morning, William.
Morning, Paul.
Hey, it's our first episode of Retirement Straight Talk, the show where we are going to try to cut out a lot of the confusing, the contradictory advice that is so often heard in the media and try to, what's the terminology, William? What would we do? Simplify the complex.
Trying to simplify the complex.
Perfect, we got it. So the first thing, well, what's on everyone's mind this year? Of course, that is their portfolio. Not a happy year for people, isn't it?
No, everything's dropping. It seems like, as we'll get into more later, there's no flight to safety. A big reason for that is due to rising interest rates, which is hot on everyone's mind as well. So we're going to get more into that and also how that's directly affecting your portfolio.
I mean, normally most people, they have what we call a balanced portfolio, which is, maybe 60% in the stock market and 40% in some type of fixed income investment, bonds or GICs or whatever. And normally those do very well when you have a normal market downturn like we're having right now.
Or at the very
least,
least,
though, this year, is it, Will?
Well, at the very least, not even so much that they do well, but they're there to protect you and provide a bit of a hedge when stock markets decline. And like you said, they are not doing that this year. They are declining almost as much as stocks are this year.
Well, that's right. There's something called the aggregate bond index, and it is down double digits, very similar to stock market. So we want to explain why that's happened. By the way, I've been in the business for 31 years. I've never seen this happen. Matter of fact, the only time even close was 1993 when the aggregate bond index was down 3% for the entire year. It's down double digits already, but there is hope. But let's talk about it, William. There's something called the inverse relationship between interest rates and bond prices. And that's kind of confusing.
Yeah, you have a simple example I know that we use all the time. So just for the benefit of our listeners, just explain that quickly, Paul.
It's kind of a counterintuitive type concept. But what it is, let's do a hypothetical example. Let's say that you could go out, every one of us could go out today and buy a Government of Canada guaranteed 30-year bond. And let's say the government was offering 5% interest on that. So in other words, you could buy this bond, and let's say we bought $100,000 worth. We buy $100,000 of this bond. For 30 years, the government guaranteed is going to pay us 5% or $5,000. And then at the end of 30 years, you get your $100,000 back. You go, you buy that, you go, this is good. I'm happy with this, no risk. Let's move forward 1 year. And let's say that in the next year, interest rates continue to rise. And now the government is offering the same 30-year bonds, but they're paying 10% yield. Wow, I want that. But you'd bought this 5% yield bond a year before. So the natural inclination, what? Well, you want to get rid of that 5% bond, right?
That's it. But the problem is, if you try and sell it in the market, why would they buy that? They can go straight to the Government of Canada and get the higher yielding bond.
That's right. When you go to sell this on the bond market, no one will give you the $100,000 that you paid for it last year. Why would they? So you have to sell it at a discount. And the discount you'll get in this case is whoever buys that bond will need to yield the same amount that they would yield if they just went to the government and bought a new 10% bond. The only way that's going to work is if you discount your price to $50,000. So, because at $50,000, all of a sudden now that $5,000 annual payment you get is equal to a 10% yield. So you would lose, think of it, on a government of Canada guaranteed bond, you lose half of your money in 1 year in our hypothetical situation. So
that's the great job. That's what happened. That's what's happened this year. Interest rates have been rising from both the US and Canadian central banks, and that has caused bond prices to fall in addition to stock markets. So now, what should people do going forward with this? Should any adjustments be made in portfolios? Should you sell out of your bonds and move more into stocks? What should be done?
Well, that's a good question. And of course, that's some of the points that some of our clients have talked about in my conversations with them anyway. But here's the situation. We recently got back from our national conference in Deerhurst, listening to fixed income or bond experts. What they're saying now is, first thing, there's actually not that much risk left in bonds because now those bonds are yielding 4 to 5%. And the suggestion was that if interest rates even go up maybe 1% more, that may lose 2 or 3% in value of the bond. But because you're earning the 5% yield, you're actually still going to make money on that. So there's not a lot of downside in bonds. And the other thing, in Canada especially, we're nearing the end. The last 2 months, we've seen inflation drop in Canada for 2 months in a row. According to those experts, we could be nearing the end of interest rate hikes in Canada, maybe 1 or 2 more, but much smaller than we've experienced. Now, that's good for the bond market, isn't it?
Yeah, the other thing too is just more long term. All this is good for bondholders because it's certainly a lot of short term pain. But for years now, bondholders have been earning very little on their fixed income just because of how low interest rates have been. But now, as interest rates are rising, like you said, you're going to enjoy higher yields on those bonds. So you have to go through the short-term pain, but long-term, it's probably good for bondholders.
But not even in addition to that, Will, if bond prices steady and maybe even, like some people are suggesting, drop in the next year, you could see very healthy returns on your fixed income portfolio, maybe even double digits. So
potentially, it's so hard to predict this stuff, predicting interest rates. That's potential to happen, but who knows? Predicting this stuff is so hard to do.
Exactly. But again, we would just about a year ago, we ended a 40-year bond bull market. Potential is there, but as you say, well, you never know for sure. So that's probably a good time to end things for our first podcast in Retirement Straight Talk with William and Paul. I'm Paul. My friend there is William. By the way, if you have a comment for us or you'd like to talk us about a particular topic, just send us an email at info@westendwealth.com. That's info@westendwealth.com.
Thanks, everyone. We're going to be doing these every week, so they're going to be released every Friday. And like Paul said, if there's anything you'd like us to discuss, send us a quick email and we'll get to it.
Great. Fantastic. Good job, Will. We'll see everyone next week.
This podcast was brought to you by West End Wealth Planning, an award-winning wealth planning practice catering to small and medium-sized business owners and to those looking to create a worry-free retirement for themselves and their families. To learn more, go to westendwealth.com. Don't forget to rate this podcast and subscribe to Retirement Straight Talk with Paul and William by going to Apple Podcasts, Spotify, or wherever you find your podcasts.